During fiscal year 2026, the Indian economy recorded a 7.4% GDP growth rate alongside a 1.7% inflation rate. This coincided with a decline in the unemployment rate to 4.8% by December 2025, indicating that the expansion occurred without overheating the labor market. Aligning high growth with historic lows in inflation is a rare outcome in macroeconomic cycles. The Reserve Bank of India functioned as the primary architect of this stability. Understanding the mechanics of this balance requires tracing the money multiplier, the specific process by which central bank policy influences the volume of commercial capital. Analyzing the 2025-26 fiscal year provides a clear view of how these instruments operate during a deliberate expansionary cycle. A bank's balance sheet begins with net demand and time liabilities, the raw deposits. Before issuing credit, direct constraints partition this capital. The first is the cash reserve ratio, a mandatory percentage held directly at the central bank. The central bank pays no interest on these CRR balances. It is non-earning capital for the commercial bank, withheld from the economy. The second constraint is the statutory liquidity ratio, or SLR. Banks must maintain their SLR in specific liquid assets, primarily cash, gold, or approved government securities. This provides a solvency buffer for the institution while creating a reliable market for government debt. By adjusting these direct ratio barriers, the central bank alters the physical volume of capital available for commercial lending. While direct ratios establish structural limits, the central bank uses a different set of tools for dynamic daily liquidity management. Daily fine-tuning occurs through the Liquidity Adjustment Facility corridor, regulating capital flow between the central bank and the market. Its ceiling is the repo rate. The repo rate is the interest cost for commercial banks to borrow overnight funds. Lowering this rate injects cheaper liquidity into the banking system. The floor of the corridor is the Standing Deposit Facility, or SDF. The SDF allows banks to park excess liquidity and earn returns without requiring the central bank to provide collateral. Shifting this daily interest rate corridor determines exactly whether capital enters the commercial market or returns to the central bank. Between April and December 2025, the RBI executed a targeted liquidity pivot using these tools in combination. First, the repo rate dropped 100 basis points to 5.25%. Second, reducing the CRR to 3.0% shifted zero-yield reserves into the lendable pool. Finally, open market operations injected over 3 lakh crore rupees into the system. This triad, combining a direct constraint release, an indirect rate cut, and direct injections, generated a deliberate liquidity surplus. The impact of these actions is visible in the transmission data. While baseline reserve money growth was moderate, the CRR-adjusted trajectory rose to 9.4%. Commercial banks leveraged these cheaper funds to expand their loan books. Consequently, broad money growth reached 12.1%. This leads to the money multiplier, the quantitative measure of central bank efficacy. This figure tracks how many times a unit of central bank money circulates through the economy via lending. By December 2025, the multiplier rose from 5.70 to 6.21. The rapid expansion of this economic multiplier indicates that the central bank's liquidity pivot successfully converted into active, circulating market capital. This monetary transmission relied on the structural health of the banking sector. Because commercial banks entered the year with non-performing assets at decadal lows, they were positioned to deploy the liquidity surge effectively. Outstanding commercial credit grew by 14.5% year-over-year by December 2025. Within this trend, the MSME sector saw a 21.8% credit expansion. This massive influx of credit into the industrial sector occurred alongside strong agricultural performance and record services exports. The 7.4% GDP growth reflects this combined momentum across manufacturing, services, and rural demand. Because the RBI utilized targeted indirect tools to expand existing capital, the expansion did not trigger high inflation, which stayed at 1.7%. Calibrating direct constraints and indirect corridors provided the liquidity necessary for these sectors to expand while maintaining macroeconomic stability.